Okay, we get to tackle alternative investments here. One of the mainstays of the alternative investment environment within the CFA curriculum has long been real estate. And this particular reading, we're going to deal with private real estate investment, which basically means that you or I are going to go out and buy an apartment complex or buy a warehouse or something along those lines, as opposed to a public investment, which would be some sort of securitization of real estate in the form of maybe a REIT or something like that, which should be addressed elsewhere. So when we talk about private real estate investment, we need to talk first about the forms of real estate. So we can think private. That's what we're going to be doing here. So this means we are going to be on title, right? So you're going to go out and you're going to buy some real estate, and it means that you're probably going to have a fair amount of cash. You can't do this with $20. You're going to have something more than that. But with public real estate, that is going to be something like buying a share in a REIT. Well, $20 or $50 might get you a share in a REIT. So if you want to be a real estate mogul and you only have $50 to work with, well, maybe there's still hope for you. We could also divide this out into debt versus equity investments. So equity is just like equity anywhere else. It's ownership, right? You have the residual claim. If things do great, the equity holders are going to do great. If things do poorly, the equity holders are going to be wiped out. The other way to approach it would be to be on the financing side. That would be to be a creditor to another real estate investor, and that is you're going to be a mortgage lender, right? Or in the public space, maybe a mortgage-backed security investor. So equity versus debt, and then public versus private would be a basic dichotomy for us. Real estate characteristics. Of course, the thing about real estate is that every real estate parcel is unique, right? There's no other real estate parcel that is exactly like that. So it is the ultimate in a heterogeneous asset type. And that means that it's its own type of asset, and you'll see that there are some valuation twists and turns here that will be different than what you would see in most other valuation settings. So the way I tell the story is that real estate was dominated by cowboys up until sometime in the late 80s or 90s. So when the alternative investment, I guess, allocation started to grow. So things are done a little different here, so you have to pay a little bit of attention. Let's see. So they have the heterogeneity, obviously going to be an issue to have to deal with. That's all right. Chaos creates opportunity. So if you want to be a real estate investor, then maybe that's a good environment for you. High unit values, already talked about, where you can't get into direct ownership in real estate with $50. You're going to have something bigger than that. Also, if you're going to do private real estate investment, you're going to be involved at some level in management. Even if it's just hiring managers or hiring somebody who hires your managers, there's going to be an active management component to it. So I have lots of students at the university who, they're graduating, they're going to get a job, and they want to buy a fourplex or whatever. And what I tell them is, well, that may make for a wealth-enhancing alternative over the long run. But remember, you're not investing here in real estate. You are starting a small business. So if you have a bunch of millions of dollars, you can probably get far enough away from it that it doesn't hurt too bad, though. So high transactions cost. Round-trip transactions cost, kind of a rule of thumb. That is, to buy real estate initially and then sell it, you're looking at something close to 10% of the initial value. So it is an arena where buying and selling is going to be restricted because of the magnitude of the transactions cost. Depreciation. So the asset is going to depreciate through time, but we're going to have accounting or tax depreciation is one thing, and that's going to be different than economic depreciation, which would be something else. And there's some tax implications associated with that, but it's beyond the scope of the curriculum. So value is going to be impacted by the availability of debt. So who is willing to lend, and the cost. That's a fancy way of saying that if there's lots of money and interest rates are low, values are going to be higher. And if credit is restricted and the credit that is available is costly, well, that's going to push values down. And the big problem with real estate is that it's illiquid. It takes a fair amount of time to buy real estate, but it's always easier to buy than it is to sell. So when you're on the sell side of that, you will. I am I guess a typical small real estate investor, and I had one of my properties that I marketed for 2.5 years. I finally did sell it, but anyway, that's fairly illiquid when it takes 2.5 years to get it done. And again, valuation subjectivity, of course, this isn't unique to real estate. but given that every parcel of real estate is unique, it's heterogeneous asset type, there are special conditions around the subjectivity, meaning that if you're buying a share of IBM stock, well, there's subjectivity associated with that, but you've got millions of other shares of IBM stock that are going to transact within a reasonable period of time that you can look at. You may not have that when you're talking about real estate. Of course, REITs were developed in part to overcome some of these problems, right? So high unit value, liquidity issues, transactions cost, active management, all that stuff will dissolve away when we move to public real estate. But then there's some problems that accompany REITs too, so nothing's perfect, right? Okay, property classification. In terms of residential, this could be it's going to be owner occupied. So if you own your own home, well, that's residential real estate. Congratulations, you're a mogul. Also, you can think of this in terms of multifamily properties like apartment complex or something along those lines. So if ownership is based on the opportunity for income, right? So that's why the property was purchased. We would think of that as commercial real estate. We actually divide that up a couple of, in common practice, we think of non-residential commercial. So these are commercial properties other than places where people live. It typically excludes farmland and timberland as well. So when we talk about non-residential properties, but the commercial properties generally then, what's left is everything else, and we define that based on the end user. So in the next slide, you can see that we have commercial property here. Well, it could be office property. That means you got people sitting in cubbies working on spreadsheets or making calls or whatever it is they do. So you could have a building that is a single tenant. You could also have a building that has multiple tenants in it. Industrial warehouse. This is going to be well, we all know what a warehouse is or other type of industrial property. So it's going to be somebody owns it. It's a part of the logistics operations for Amazon, and they pay rent on it, and that's how you get your return. Retail, of course, this is going to be shopping centers, malls, those types of things. Hospitality, this is going to be hotels, maybe amusement parks, conference centers, and the like. And then everything else we're going to lump together: restaurants, parking, recreational, those types of things. So commercial properties, if you're not talking about something where people live, or you're not talking about timberland or farmland, then everything else probably falls into this category of commercial, which of course can be broken down in lots of different ways. Okay? And it's broken down by end user, not just because we like to break things down by different metrics, but because each of these different types of properties is going to have unique characteristics, and they're going to respond differently to changes in the overall economy, changes in interest rates, all that sort of stuff. So you're going to have its own supply and demand characteristics, and the intensity of management is going to be different. So if you're talking about a hospitality, management is going to be very intense. If you're talking about an industrial property, then management is likely to be much, much lighter. So all of these different categories are going to have their own, their own attributes. There's still going to be some commonalities among them, but you're going to have significant differences as you try to value each of these different types. So why do you invest in real estate? Well, I think there's a couple of reasons to do that, but current income might be one of them. So if your rents less your operating expenses, financing costs, taxes, all that sort of stuff, well, if that's the case, you can buy properties that are going to cash flow, then you can have some current income from it. The thing that most people think about, like with buying an equity security, is capital appreciation. So you're going to buy it for $10 million today, sell it for $100 million in 5 years. Well, that's going to be, that's a nice real estate investment. If you can buy it for 10, sell it for 100 in 5 years. Also, real estate works as an inflation hedge. So if you think of, all right, well, imagine a period where there's lots of uncertainty about inflation, and you're thinking, well, if I buy bonds, what's going to happen? All those types of things. Well, if you buy real estate, inflation is a general increase in the price level. One of those prices is rents, right? So if you have 10% inflation each year for 10 years, which would be a bad thing, but nonetheless, if that happened, well, you're going to see rents increase. So it's going to serve at least partially as an inflation hedge because you're actually selling goods into the market. In this case, you're selling space, or leasing space. So as prices go up, You could go up a little less than average or more than average because, of course, you know, if inflation's 10%, some things increase more, some things increase less. But nonetheless, you at least have some inflation hedge there. So there's tax benefits in some countries, so the United States being one of them. And then the idea of diversification. So the reason this shows up in alternative investments is because it has a relatively low correlation with traditional investments. So if you look at investment in, you know, large cap stocks, you know, investment grade bonds, all that sort of thing, well, the correlation between traditional investments and real estate is, in particular, if you're talking about private real estate investment, is lower than the correlation between traditional investments and other traditional investments. So it's a diversification play. Also, potentially higher returns, but it depends on exactly how good you are at doing this. What about risk factors? Well, the risk factors go on forever here, but, you know, business conditions certainly impact the value of, you know, in particular, commercial properties, right? So you think of what's going on with GDP, inflation, you know, all that sort of stuff. That's going to feed into the business, the returns from the business of owning real estate, right? There's a long lead time for development of new property, so you can start a property today, have great conditions under which to you know, lease it up and then sell it or whatever you're planning to do. But by the time you finish it, okay, you can be in a completely different world. So the house that I live in was bought or was started by one developer who went into then the financial crisis hit, and that developer went under, and another developer took it over, and they went under, and then I bought it from the bank, and then 30 days after I bought it, the bank went under, right? So, I mean, the conditions under which the property came out of that, the economic conditions when it was finished were much different than when it was started. So cost and availability of capital, we already talked about that, but you know, how easy is money? What does it cost us? Unexpected inflation. So if you're going to be on the debt side of this, you're going to enter in, you're going to be buying, in particular, if you're buying fixed income or fixed rate mortgages, then, you know, if rates go up, the value of those mortgages is going to go down. Demographics can change. So my hypothesis is that and this is not curriculum, but the value of really large homes, not really large homes, there's always going to be a few billionaires that want to show off, but if you're thinking, you know, 5, 6 bedroom, 5,000, 7,000 square foot homes, I think as society gets older, the value of those are going to go down. As people have fewer children, I think the value of those is going to go down, maybe not literally go down, but not go up as fast as other real assets. So, and then of course, illiquidity, that's a big deal in real estate because it can take a long time to sell. Environmental risks, so you can have a sinkhole open up underneath you, those types of things. The availability of information, this is going to be different than it is in analysis of normal financial assets. So there's lots of information on real estate, but it is, remember, since every piece of real estate is unique, then the ability to you know, do standard analysis is going to be limited compared to, you know, buying a share of stock or something along those lines. So management, we already talked about asset management in terms of, well, I'm going to buy a property, I got to manage it. Well, managers have a big impact on return in real estate. This is something, you know, quality of management is going to make a difference. Leverage, of course. One of the reasons people like real estate investments is because they can be fairly highly levered. Brick and mortar tend to make good collateral, or at least the banks think that. So you can get, you know, high loan-to-value ratios, and you can, you know, lever up. And then if you have, you know, reasonable asset returns, well, then the equity return will look good. And of course, there are other risks that they're not identifying here, so I'm not going to worry about, you know, unspecified risks, right? So if none of these show up on the exam, they say, is there anything else? You'd have to say, yeah, it's an unidentified risk. Okay, so what about putting real estate into your portfolio? Well, the notion here is that real estate has bond and stock characteristics, right? So the bond part of it, if you think, okay, I've got this office building, it's leased for, you know, 3 or 5 or 10 years. Well, the payments from that look like the payments from a bond, right? So fixed rate payments, and you know, it has some bond-like characteristics. On the other hand, that lease is eventually going to end, okay, which gives rise to some uncertainty over the renewal. and the rate at which it's going to be renewed and all those types of things. So, you got to think about the probability that the current tenant's going to renew, and if not, how long is it going to take to release it? That's going to be dependent on the state of the economy. While we have some bond characteristics, it also has some equity type characteristics, and if you look at the variability, then overall it lies between bond and stock variability. So it's going to be something in the middle, and that's not surprising given that it has both types of characteristics. Okay, let's talk for a few minutes about the different types of commercial property in just a little more detail. There is lots of detail here, so this is going to be a number of slides, and I think the point here is to get the big picture. So for each of these classes of property, you probably want to understand the major drivers of success. That is, what is it that's going to keep the property leased and maybe provide for some growth in lease rates, those types of things. And I think if you get that down, then I think you've got a big part of what you need out of this. So let's start out with office space. So what's going to be the prime driver of the value of office space? Of course, this location thing. Okay, I agree with that. There's just not much they can say about that for the exam. So what's the prime driver of commercial real estate? Answer A, location, B, location, C, location. Anyway, so if we want to get past that a little bit, then the big driver of the value of office space is going to be job growth, right? So is the economy creating jobs? Are we, what's happening with the use of space or the intensity of use? So things like people working from home, job sharing, that type of stuff will also have an impact. Okay, the length of the lease is going to be important, and it varies fairly dramatically internationally. So in the United States, we typically have 3 to 5 year leases. In Europe or in the UK, they're going to have 10. Elsewhere in Europe, they're going to have long leases with essentially guaranteed renewals. The structure of the lease environment is going to vary a lot based on the country in which you're operating. So we're back to I guess the adage that there's no substitute for experience. So if you want to do real estate in the U.S., then learn U.S. real estate. If you want to do real estate in the U.K., well, expect to have some additional things to learn because there are significant differences. A couple of terms here for commercial properties: gross lease versus net lease. A gross lease, okay, you're going to pay me $15,000 a month, and you can occupy the space, and then I'm going to take care of the operating expenses, right? I'm going to have the yard or the grass around the building mowed. I'm going to, whatever sort of maintenance issues come up, those types of things, that would be a gross lease. A net lease, and this is actually parsed out much finer than what this would indicate, but for our purposes, a net lease is going to be where the tenant pays the operating expenses, okay? And we can talk about operating expenses and increase in operating expenses, and we can extend that to taxes and all sorts of stuff. So, but a net lease, that just means the tenant is going to be paying the operating expenses for the property in our in this reading anyway. Okay, so the hybrid is where you can have a pass through. The landlord pays it, but the tenant then reimburses. Okay, and remember, this is going to become a big deal for us in a little while when we talk about valuation. Rent review frequency. So how often do we get a chance to change the rents? Okay, so if rents are going up, okay, well, we want to be able to increase rents to market more frequently. So how often do we get to do that? Well, it's going to vary. It's going to be determined by the lease structure, but it's going to also have big differences between countries in the way that works. Okay, so the second type of property here, industrial and warehouse. So what's going to determine the returns to your industrial/warehouse investment? Well, the overall, economic growth, right? So when the economy's growing, we're buying more stuff, we're running more trucks down the road, we have to have the lathes turning more hours during the day, whatever it happens to be. So the general economic environment is going to be the biggest determinant of what's going on with warehouse stuff. Also, import-export activity. The majority of these leases end up being net leases. So you lease the warehouse to Amazon, and then they take care of everything from that point forward. And I say everything, of course, all leases are negotiated. These are custom agreements. So we're keeping things simple, saying that the tenant's going to pay it. Pay all the operating expenses, but you have to be really careful in what you're doing, to read the lease very carefully when it, because there's going to be lots of ins and outs, I guess. All right, what about retail space? Well, the big determinant of retail space is going to be consumer spending, and consumer spending is going to be determined by, GDP growth and job growth, changes in the population, all that sort of stuff. So, the same, if you think about, well, what is it that makes that strip mall down the street from your home successful? So when all the units are, have tenants in them, and they're, you can tell that it's well maintained, all that sort of stuff, versus the, 5 years ago when only 2 of the 7 units were occupied, that type of thing. Well, it's going to be the overall economy and people's readiness and willingness to spend, right? So, consumer spending is going to be a big impact there. The quality of the property, is going to vary a lot, and you can tell it when you drive by it, right? So, a high quality property is going to attract different tenants. Different tenants are going to attract different shoppers. So, that's going to be a big determinant of, where you go and which properties are successful, or at least determinant of value in the terms of impacting leases. So you can have an old strip mall that is mostly occupied by adult bookstores and tattoo parlors and still be a great investment, okay, but its valuation is going to be lower than one that has, Bed Bath & Beyond or, something else in it. So, size, of course, is going to be a big variable, and again, the tenants, in particular the lead tenants, are going to be what brings the shoppers into the center. Okay, what's very common in this type of lease is what's called a percentage lease. So there's going to be a base. That is, you're going to get, if you're the landlord, you're going to get $10,000 a month, plus you're going to get some percentage of sales or something like that. Can be determined in a lot of different ways. But if the tenants do really well, you're going to get some sort of kicker from that, is the point of a percentage lease. All right? Multifamily, well, what's going to be the determinant in multifamily? What you want to do is you got to keep them leased, and you got to keep them leased at high rental rates, right? So that's going to mean population growth in the area. So you have people moving in. Well, if you're in Detroit, you got people, that's going to be, what, half the size it was a few years ago. If things continue, or has it already happened, something like that? Well, if you owned a bunch of apartment complexes in Detroit, I'm guessing that it's been a hard road for you, right? So population growth has been negative, so those multifamily properties are, to keep people in there, you're reducing rents or you're bearing lots of vacancy. So the age of the renters, as people age, they tend to migrate from renters to owners. So, and then of course home ownership rates do vary internationally, and if you live in the United States, you think it's one thing, but if you live in Amsterdam, you think it is something else. Okay, so the ratio of home price to rental, this is something that got historically skewed during the financial crisis. So it just became, I happen to live in Provo, Utah, and during the financial crisis, it became much cheaper to own a property than it was to lease a property, right? So that led several big funds to start buying properties and leasing them and those types of things. Interest rates, of course, are going to affect home ownership, and then the owner is normally responsible for property upkeep in this environment. Let's see. So what about appraisals? So we're talking about assessing the value of the property now, and of course we can get an observation on the market value of a property, but we may only get that once every few years or once every 50 years if we're talking about some sort of the Rockefeller Center or something like that. So the market value is something we can observe. When we're doing an appraisal, we're trying to estimate what that market value is, right? So we don't have an identical asset. It's not like I want to know what this value, value of a share of IBM stock is, and 8 seconds ago an identical share changed hands, and I can just look at that, right? So I'm going to have to come up with a way to find the value of this particular real asset with looking, or its probable sales price, by looking at comparables or cash flows or something like that. So the market value, that's what the property would transact for between normally motivated parties, meaning that I want to buy, but I don't have to buy today. The other person wants to sell, but they're not particularly distressed. That's what we're trying to estimate. Okay, as opposed to investment value. Investment value is the value for a given investor. That means that we need to know the characteristics of the investor in terms of how much equity they're going to put into the project, what sort of financing can they get, what is their, potentially what is their tax position, those types of things. So investment value is for a particular investor. Market value is for just a normally motivated transaction. Value in use, this is, what is it worth to us as a part of our business. And you can think of that, it's easier to think of it in terms of real estate than it is elsewhere. So the accounting model frequently asks us to think of a value in use under U.S. GAAP. Well, if it's, a pizza oven, how do you come up with value in use? Because there's, it's one cog in a machine. But value in use is a little easier to determine if you're talking about a particular business or a particular asset within a business, but still that's going to be difficult. We also have assessed value. Okay, so this is going to be how the tax authority values it, and they're getting more and more sophisticated with that. It still seems that it lags behind, but nonetheless, that's going to be important because that's going to determine property taxes. And then mortgage lending value, well, as it turns out, brick and mortar end up being pretty good collateral for loans. So the mortgage lender is going to have an assessment of its value, and then that focuses on the asset as collateral for a loan, which could be a little bit different, although I think that its value here is probably closely related to its market value. All right, so valuation approaches. How do we come up with the value of a piece of real estate? Okay, well, several approaches. The first would be a cost approach. We see this, if we wanted to value a business, we could do this. We come up with the value of all of their assets, subtract off the value of their liabilities, estimate what it would cost to put the financing structure back in place, all those types of things. It's very difficult with a business because of all the intangibles. There are intangibles in real estate as well, but they tend to be less troublesome. So what we would say is, look, I want to value this apartment complex at the corner of 5th and Main. Okay, well, what is the value of the apartment complex at the value of 5th and Main? Well, what if instead of it being on the southeast corner, we looked at the northwest corner? We said, well, the value of that land, okay, well, that's about, that's close by, so we can get the cost of the land. And then we go out and we say, well, what is the value of the sticks and bricks? Okay, so that is, hire an architect, bring out the materials, hire the labor, bring it up out of the ground. So the land plus the cost of the building, less depreciation, which we'll talk about later, because everything wears out over time. So depreciation clearly the most difficult part of this to measure, it is, again, easier maybe to measure it in real estate than it is in some other valuation environments. And this would represent sort of a maximum potential value for the property. So, well, I could buy it and build it for that. I'm not going to pay you more than, whatever I get as my cost. Sales comparison is, if you've ever bought a home, then you've witnessed the sales comparison approach in action. That's where we're going to say, look, I want to know the value of this particular property. So, here's the house, right? So I want to know the value of that property. Well, I'm going to go and I'm going to find 3 other houses in the same neighborhood, okay? And I'm going to see what they sold that have recently sold. And I'm going to say, well, okay, let's get a price per square foot. So just like we do relative valuation, price to earnings or price to sales or price to cash flow. Here I'm going to get a price per square foot of houses in the same neighborhood. I might have to adjust because this one has a pool, this one is 5 years older, and this one is in terrible condition. So I have to go in and adjust the sales prices, but then I'm going to bring it down to a price per square foot, and I'm going to apply it to the house that I'm interested in valuing to begin with. So sales comparison approach, for $350, you can have an appraiser come out and tell you the value of almost any single-family residence using a sales comparison approach. I personally think they don't do a very good job of it, but nonetheless, that's just my opinion, right? And the third is the income approach. What we're going to see is that they're really going to parse things out in 2 ways for income. They're going to call it something different, but it's really going to be an income approach. So it's going to be net present value. That is, okay, well, here's how much I have to pay for it. Here's the cash flows through time. What is the NPV of this project? So the present value of the future income discounted at the required return. Okay, what is exactly the investor's required return? We're going to play with that a little bit. But nonetheless, it's just saying discount back those future cash flows. So, and this, of course, requires that the property actually generate income or have the ability to generate income. And most properties do. In one form or another, but if it's not a typical income generating property, it's farmland, or it is timberland, or something, it is a home in a single family neighborhood that has very high owner occupancy rates, then using the income approach is going to be difficult in that environment. Okay, highest and best use, this is just the assumption here that the site, the land that we see along with this property, okay, it is in its highest and best use. So if you see pictures of this little bitty building that's surrounded by all the skyscrapers, and that's because you had somebody here that was holding out and no politician was willing to use eminent domain to get rid of them and all that sort of thing. Well, that property, the land underneath it, is probably worth a lot more than the property if it were sitting anywhere else. So that is not its highest and best use. So if you have a property that's not in highest and best use, depending on how egregious it is, it's probably best just to tear down whatever's there and convert it into highest and best use. So anyway, the assumption underlying the appraisals frequently is that the land value that's implied by the valuation or by the appraisal is as high as it could be. All right? Okay, so let's talk about income again. So this is what they're going to call direct capitalization. Okay, and again, the CFA curriculum is a discounted cash flow curriculum, and it is what we're going to be doing here is discounting cash flows, right? So they're going to talk about discounted cash flows being something different than this, and this is sort of a funny way of estimating cash flows, but it breaks down to this. Are we simply going to use the Gordon growth model on 1 year cash flows? That's direct capitalization. And then when we talk about discounted cash flow, we're going to be using something that's like a two-stage model. We'll also be using potentially a different calculation there of what's going on in terms of the bottom line cash flow. But again, we're just discounting cash flows back to today, either in one step or multiple steps, but we're just discounting cash flows, so don't lose track of what's going on. All right, so what is NOI? So NOI stands for net operating income. So what we're doing is calculating year one NOI. That's going to be the value that we plug into what is essentially the Gordon growth model, or what is the Gordon growth model, but it's going to look weird to you. We'll see it in a moment. Okay, so we're going to calculate the first year NOI. And what NOI is, it's sometimes called F and C, right? F and C, which means free and clear, right? So it is the pre-tax return to an investor who owns the property free of any liens. So you don't have any debt service, that sort of thing. That's NOI. It's the pre-tax return to an investor that owns the property without a lien. Now, this is just a valuation metric. It doesn't mean that the property actually doesn't have any liens against it. So you may buy it and take a big lien against it, right? To go out and get a big loan, but this is how we're going to value it, based on this free and clear income. So NOI, we're going to start with our rental income if it's fully occupied, plus any other income. That would be soda machines, gym, a laundromat, whatever it is that you have in this facility, and that's going to give us our potential gross. So potential gross is sort of where I think of as the starting point. Easy to get to, especially on a multiple choice exam. They're going to tell you, here's rents, here's anything else that's going on. If they do it monthly, total that all up, add it by, or multiply it by 12, that's going to be potential gross. So what is the most that you can bring in from this property? That's potential gross. Then we're going to subtract out V and C, okay, vacancy and collection. This is, it's going to be a percentage of potential gross. So if potential gross was $100, then V and C was 10%, well, then we'd subtract out 10% to get us to effective gross. And then we're going to subtract out operating expenses, all right? So operating expenses are going to be what is necessary to keep the property operating. That is, we got to mow the lawn. Okay, maybe we have a water bill we have to pay. We pay for the electricity on the lights in the parking lot. Anything else that would be required, including property tax. Right? So taxes on the real estate itself are an operating expense. When we subtract that out, we're going to be down here to NOI, net operating income. Now, if you own the property, from there, you would have to say, okay, that's NOI. Now I've got to go and pay the bank whatever I owe them if you have a lien against it and you have tax implications and that sort of stuff. But this NOI, it's the pre-tax return to an investor who owns the home without a lien, or not the home, the property without a lien, all right? So direct capitalization. What do we do with NOI? Well, we calculate that for year one, okay? And then we're going to drop it into a valuation formula. So let's add some numbers to it real quick. We're going to compute NOI for the following property. It's going to be an apartment complex. The rents are going to be 1,500 euro per month. And there's going to be 30 apartment complexes, and then gym memberships for each of the 30 units are going to be $50. Let's see, V&C, vacancy collection, is going to be 7.5% of potential gross. Utilities and maintenance are going to be $200,000. Property taxes, insurance are going to be $75,000. Interest is going to be $50,000. The income tax rate is 35%. If we plug all that in, what do we get as NOI? Okay, well, of course, this would be not atypical of what you would see on the exam, meaning that they've given us all this information, rental rates, number of units, gym membership, okay, vacancy and collection, but they give us more than we need, right? You don't need interest expense and you don't need income tax to calculate NOI, right? Because this is the pre-tax return to an investor who owns the property without a lien. So interest and all, it's all real, but that's not what we're calculating when we get down to NOI. So plugging all this in, that gives us, if you take the 1,500 euros times 30 units times 12 months in a year, that gives you 540,000. Then we have the the gym memberships. So add all that together, and that's going to give us 558,000. 7.5% of that is 41,850. So potential gross minus our vacancy and collection gives us an effective gross of 516,000. We subtract out the operating expenses of 275. Okay, that was the maintenance and then the property taxes and insurance, which gives us an NOI of 241,150. Notice that it does not include anything about income taxes or interest. It does include here property taxes, right? So property taxes are associated with operating the property. Income taxes based, it would be based on the tax position of the owner, okay, but that's going to be separate, right? So that's going to be farther down because we'd have to consider how much of this is interest and all that type of stuff to get to the bottom line after tax cash flows. All right, so anyway, so this is NOI, 241,000. If we're doing direct capitalization, what do we want to do with that? Well, what we're going to do is it's called capping it. We're going to take the NOI and we're going to cap it. All right, so if we think back to the Gordon growth model, that told us that the value of any asset today was equal to the cash flow at time 1 divided by R, the required rate of return, minus the growth rate. Okay, that is the Gordon growth model, right? One of the most commonly used formulas across all 3 levels of the curriculum. Well, what we're doing is we're looking at a pre-tax cash flow, NOI, and we estimated it for year 1. So we're going to take this and we're going to say, okay, let's take NOI and use that as our time 1 cash flow. And then we want to divide by R minus G. But in real estate, we're going to do something a little different. Why? Because like I said, this was something that was dominated by cowboys. So we're going to have a cap rate. Okay? So that cap rate is going to be R, capital R. But remember, capital R, the cap rate, is just R minus G. So if they tell us that the cap rate is 10%, and they tell us that the growth rate is equal to 2%, okay, what some people might do is they might say, well, okay, let's take 10.1 and subtract off 0.02. Well, if they say the cap rate is 10%, they've already subtracted the growth rate from it, right? So if you take this and divide it by 0.08, well, you're going to get a value that's going to be too high because you've subtracted off growth twice, all right? So in your mind, make sure that you distinguish between the cap rate, which is equal to R minus G, and R minus G, which is little r, the required rate of return or discount rate minus the growth rate, all right? But when we get that right over here, so if we come over here and we take the NOI over here, we take the NOI, we divide it by the cap rate, that gives us the value of the property, and it's nothing but the cash flow in year 1 divided by R minus G. You've seen it 100 times, so there's nothing new here. The question is, where do we get this cap rate? Well, we get the cap rate from market transactions. So we go out and we say, okay, well, the cap rate is for a particular type of property in a particular environment. So we would talk about, you know, Class A office space in Boca Raton, right? Well, then we go out and say, well, there's 5 properties that have sold that are, you know, Class A office space over the last quarter. Okay, we get the NOI from those properties and we divide them by their sale price, the value. So we had an NOI of 100, a value of 1,000. Okay, and that gave us a cap rate of 10. We did that for a number of transactions. We took the average. That's where we get the cap rate. So the NOI at time 1 divided by the cap rate gives us the value. All right? Now, and I'm not going to change anything, but there's one more definitional aspect of this that we've got to keep straight. So first of all, cap rate is nothing but R minus G. So that's just, you know, how we write it down when we write a formula. Okay, so we know that. But there's also this formula down here. All right, and that is where we take the rent and divide it by this ARY. Well, what does that mean? Okay, well, if the tenant is obligated to pay all expenses, okay, so they're going to pay you $1,000 a month, so that's going to be $12,000 a year. Okay, so you got $12,000 a year in rent, and it's a credit tenant, so you think you're going to get paid that, and they pay all operating expenses. So they pay all the taxes, all the increase in taxes, all the operating expenses, all the increase in operating expenses, you know, all the insurance, they pay everything, all right? Okay, well then we have something, and this is actually used in European real estate, not in U.S., or at least not that I've ever seen. We have this all risks yield, ARY. So if you have the tenant that pays everything, right, regardless of what happens, the tenant's responsible for it, then NOI is going to be equal to what? It's going to be equal to rent, right? So for that particular lease, if the tenant's responsible for everything, NOI is equal to rent. So this formula doesn't change anything from what we see above. It's just, well, okay, what's the NOI for that property? Well, it's the same as the rent. It's $12,000 a year. And then the all risks yield is just the cap rate for this particular kind of lease. So it's the, you know, it's a really stable kind of lease. You've leased it to a credit tenant, okay, so the cap rate is likely to be very low. But nonetheless, this all risk yield is just the cap rate when the tenant pays all expenses. Okay? And if they pay all expenses, then rent and NOI are the same thing, right? So anyway, don't be confused by this. It's just definitional. All right. Okay, so having that down, we know how to use this. We could take our property, we calculated a value of $241,000, and we could plug it in, and you know, if we had the cap rate of 10%, then take 241, divide it by 0.1, and you get $2.4 million as the value for the property that we calculated the NOI for a few minutes ago. All right. What about properties that are currently being renovated, or that are somehow there's some short-term upheaval in the property or the area around the property that's going to cause cash flow issues in the short run? Well, the point here is that we want to use what's called stabilized NOI, and so let's explain this via working through a little example. So using stabilized NOI, on January 1st, renovations for an apartment building commenced. Because you have this renovation going on, you got blocks of apartments you can't rent, plus all the construction, you know, that deters new renters from coming in, whatever it happens to be. But for this year, because of the construction, we have an NOI forecast for this coming year of $5 million. In the absence of the renovation, okay, in the absence of the renovations, the NOI would have been $7.5 million. So that would have been NOI at time 1, that is over the first year, if it weren't for this, for these issues. So the NOI has a growth rate of 5%. Renovations are going to be completed at the seller's expense. So I'm buying the apartment complex today. The seller has agreed to finish off whatever this was, but I'm still going to be the one having the rent impairment over the short run. So and the we want to estimate the value of the property, assuming the investor's required return is 10%. Now, let me point out that they have not given us the cap rate, right? So they said the investor's required return is 10%. So if we were going to do this, we would want to say, well, let's find the value by taking NOI at time 1 and dividing it by capital R, the cap rate. Okay? Well, and we have NOI at time 1. We got 2 choices for it. Okay? But we're going to have to go back to the R minus G thing, right? So we're given R and we're given G. Okay? So we can calculate this. But you've got to make sure that you recognize, well, are they giving me a required return, in which case I've got to subtract G, or are they giving me the cap rate, in which case G has already been subtracted? All right? So be careful with that. But then the big issue here is, well, what is NOI at time 1? Is it $5 million? That's what I'm actually going to bring in. Or is it $7.5 million? That's what it would be in the absence of the renovations. And remember, we're forecasting cash flows through time here, right? So the 5 is what's actually going to happen, but 7.5 is much better as a forecasting base. Right? So if you're going to forecast, then this looks a lot better. If you want to think of what actually coming in, this looks better. Well, the point here is you're going to use a stabilized NOI. So use the NOI that would be the good base for forecasting. So we're going to take $7.5 million. We've got a cap rate of 5%. That is a required return of 10 and a growth rate of 5. So 10 minus 5 is 5%. So the value of this property is $150,000 or $150 million if we didn't have this short-term impairment. So we're not going to pay $150 million for it because we're not, $2.5 million is not coming in this next year, okay, during the renovations, compared to what we were using as the baseline for our valuation. So what we got to do then is say, look, if we had $7.5 million, it would be worth $150 million to us. But what we can do is say, well, let's now subtract out the impairment in the cash flows for this first year. So the interest rate is, the discount rate's 10%. Over this next year, we're going, so N is 1, no payments. We're going to lose $2.5 million. So the present value of the foregone NOI, because of the construction, is $2.27 million. So the value of this property using a stabilized NOI is the value if we didn't have NOI, just short-term NOI disruptions, minus the loss associated with the NOI disruptions. So it's going to tell us that what we should actually pay for the property is $147.7 million rather than $150 million. All right? So, and we could have this disruption for 3 years, and that would just change how many years we had to put into our loss during the renovations, right? Okay, so stabilized NOI, I don't think that's a huge point, but you want to make sure that you understand what's going on there. Now, let's say we want to value an apartment complex. So what we'd like to do is take the NOI for our apartment complex and divide it by the appropriate cap rate. The trouble is, while we can get pretty good data on what properties sold for, we can't necessarily get value or get good data on their NOI. And of course, NOI varies across properties. It has big influences from age and that type of thing. So what we could do, we'd like to do a price to earnings ratio, okay, or a price to cash flow ratio. So that's effectively what we're doing when we get a cap rate. But if those things don't work, remember we sometimes go to price to sales, right? So a price to sales ratio where we take and say, well, what's the price per unit of sales? Well, we could do the same thing by looking at the potential gross income. So we could take a value based on potential gross income, and the advantage here is we know this apartment complex sold, and we know how much it sold for, right? We don't know its NOI, but we can stand out in front of the apartment complex, count how many units there are. Oh, there's 15. Call the leasing office and say, how much is each unit leased for? $1,000. Well, that's $15,000 a month times 12, so it's $180,000, and it's sold for whatever. In other words, we can create a gross income multiplier. So we can, without knowing what the NOI for the property is, we can't calculate cap rates, but if we know the sales price, which those are well known in the market, and we know the gross income, right? What is, if we had them all leased all year long, all that sort of stuff, well, then we can calculate from this data the gross income multiplier. Then we can take the gross income multiplier and multiply it by the gross income for our subject property. All right? So this is it is price to sales is the same thing. You're not really interested in sales. You're interested in profits. Gross income multiplier, you're not really interested in gross income. You're interested in net operating income or something like that. But because of data availability, this would be another way to approach the valuation problem. Okay, so let's look at the DCF method really quickly. So DCF, discounted cash flow, there's nothing new here that you need to worry about. So we've already talked about how to calculate NOI. So, we started out with the rents and subtracted out the costs, all that sort of stuff. Well, all we're doing here is saying, look, we're going to have to forecast rents for several years. So potential growth rents, next year are going to be 100. Maybe you forecast those to grow at 2%. So 102, 104 something, or whatever, however far you want to forecast it. So all we're doing is we're forecasting the NOI through time, and then at some point, usually in real estate you go out 10 years, but there's nothing written in stone about that. At some point you're going to calculate a terminal value. Well, if I forecast the NOI at time 1, time 2, time 3, and time 4, okay, I'm going to call this time 4 here, put 4 there. Well, then I can calculate a terminal value. I'm going to have to get an NOI over here, right, because we got that 1 period delay. If I want the terminal value at time 4, I'm going to have to take the NOI at time 5, and then I'm going to have to divide it by the appropriate cap rate, but that's going to give me the terminal value. In other words, just like we did with two-stage growth analysis for an equity security, okay, we use the Gordon growth model to come up with a terminal value for this real property, and then we just discount it all back, right? So we've got to estimate this future NOI, and we have to have a terminal value, okay, and we've got to have a cap rate. Okay, so the cap rate's going to be dependent on, macro policy and all that sort of stuff, but so is the cost of capital in any other valuation setting. So you've got a lot of things you have to make assumptions about, but that's just the nature of valuation generally, right? So we can do that, DCF, just like everything else we've been doing ever since level 1, right? So different lease structures. Okay, so in the United Kingdom, again, so what we're doing basically here is comparing U.S. to UK real estate. So net leases are very common. Remember what they're likely to do here is go to the all risks yield, the ARY. Okay, so that's going to be, it's net, it's what we would call triple net. The tenant's going to pay all of the expenses. So rent in the first year and NOI in the first year are going to be the same thing. So this cap rate is going to be the ARY. Typically, and this is a structural difference in the way we write contracts, and it's going to that will impact valuation. In the U.S., we have lease terms of 3 to 5 years would be typical for commercial real estate. Okay, those are 10 or longer 10 years or more if you're looking at leases in the UK. So what's going to happen is we're going to have rent reviews. So if you think, well, I've got this property leased for 10 years, well, what happens as rents change? Well, what's going to happen is you're going to have some period where the rent is fixed, and then you're going to have a reversion period, which just means that you're going to go in, you're going to hire someone to say, well, what would be the market lease rates at that point in time, and that's going to go up, right? So if the market rents have gone up, then the rents on your building will go up, and the tenant stays the same, but the tenant has agreed to a market rent adjustment at multiple points during the lease would be a typical outcome. So open market rents adjusted to the current market rates is what we're going to do. So the way what this does to us is that it creates a valuation scenario where we're going to look at the rental period, that is the period over which we have fixed rents, and then we're going to look at the reversion period. That's after the rents migrate to market value. And so if you're looking at this over time, okay, and this is going to be our rental rate, then up until the reversion, maybe that's for the first 5 years, rents are going to be constant, right? And then we're going to have to decide what's going to happen after 5 years. Well, maybe we think that the rents are going to go up, would be our normal assumption, and then rents thereafter are going to be higher. And of course, if we really wanted to do this, we'd have to think, well, this building is going to be serviceable for 90 years, and we'd have to do it. But on the exam, what they'll probably do is have a rental period and then a reversion period that's assumed to go on forever, and we're going to value those separately, but all that means is we're going to discount it all back to today. We just have this one change in rents. There's also the notion that the rental rate here has more uncertainty because we've got a contract and we've got a fixed rate over the short run. So we may have a discount rate of 8% during the first 5 years, but after that we may want a discount rate of 9.5% just because we have this added element of risk. That is, what are rental rates going to be? Maybe at the time of the reversion, okay, that is when we reevaluate rents, we'll have another financial crisis and rents will be pushed down by 30%, right? So there's more risk there. So typically we'd have two different discount rates, one to apply to the rental period, okay, and the other to the rest of the time, the way it's applied here, to the rest of time because we have additional risk associated with it. Okay, DCF assumptions, lots of assumptions here, right? So we got to project all that income, you know, from the existing leases. Okay, we have to think about lease renewal assumptions and do that in the U.S. Just like you would in the U.K. Well, what are the new rents going to be? How long is it going to take us to release the property? How do market rents change? Okay, operating expense assumptions. Okay, what about CapEx? You got to replace the carpet, put in a new HVAC. Okay, vacancy is going to change dramatically through time. Times are good, vacancies are low. Times are bad, vacancies are high. Okay, what can we sell it for in the future? Okay, rent reviews if we're talking about you know, a market adjustment. Okay, what about the discount rate? So how's the discount rate going to change? Lots of assumptions associated with valuation here. Of course, there's always lots of assumptions associated with valuation. The alternative is the Homer Simpson strategy, which is just to hide under some coats and hope everything works out all right. Well, you either make assumptions and, you know, get some idea of value and what's going to be critical to your success in the project, or you know, I guess you can just work at Walmart as a greeter or something. But if you're going to be in finance, you got to be comfortable with making some assumptions. That's not an excuse. Okay, you've got to do lots of work with it, obviously, but a lot of assumptions to deal with. Okay, so DCF versus income. So this is all really discounted cash flow analysis. This one is done in two stages. Okay, we're going to estimate some NOI for a while, and then we're going to have a terminal value. This one is done in one stage. Okay, so we just use the Gordon growth model, but it's really all discounted cash flow, but they're distinguishing here. All right, so discounted cash flow means two stage. Income valuation, or what they also call direct capitalization, means you just are going to plug it into the Gordon growth model. So DCF, we're going to forecast NOI, future CapEx, all that, getting terminal value at the end. Okay, with the income capitalization, we only have to calculate 1 year of NOI, and then we need to come up with a capitalization rate, that is a required return and growth rate. So in DCF, it's going to be dependent on appropriate discount rate and terminal cap rate. My experience is people are very optimistic about terminal cap rates, but you got one cap rate that you have when you're going in. That's the going in cap rate, and then the terminal cap rate, and the lower the cap rate, the higher the value. So you got to be realistic about that. Direct capitalization, the cap rate from comparable transactions. So you've got to go in. You're going to say, what's the going in cap rate today? You apply it. You don't have to worry about making this other assumption about cap rates in the future. In terms of common errors, okay, discount rate fails to capture risk. There is substantial risk with real estate. If you look at low leverage companies, look at the equity in low leverage companies versus asset value or the performance of the asset and for real estate, those have about the same variability through time, right? So it's as variable as real estate is as variable as low leverage equity. So income growth typically exceeds expense growth. There's fixed expenses and people miss that at times. So the terminal cap rate and the going in cap rate are inconsistent. Well, why is it that somebody's going to be willing to pay more for the building in 10 years when you get ready to sell it than you're paying today? The terminal cap rate is applied to an atypical NOI. In other words, you make assumptions about how you get to that NOI, and that's basically a nice way of saying that they're overly optimistic. And then, of course, people forget about the cyclicality of the real estate markets, right? So it's not any predictable cycle that you can say, oh, every 5 years or 7 years. You hear people say that. There's no predictability to it. But real estate, just like investment in equities, is cyclical, and you have to be able to deal with that. All right? So let's think of the cost approach one more time. So remember we said we're going to take the land value, so we'll use sales comparison to come up with that. Construction, well, that's replacement cost. So we're going to use modern materials, modern building code, all that type of stuff, and potentially modern design. So if you're looking at a building that was built in the 90s, and maybe it's a strip mall, well, in that case, you may have smaller unit size, because that was what tenants were looking for at that time. Today, we need larger unit size, right? So we use modern layout to the building. So we're going to take the land cost plus the construction cost. Well, okay, if we could buy the land and build the building today, it'd have the modern materials, it'd be up to code, the space would be oriented right. Yeah, that's going to be worth more, so we're going to have to subtract off economic depreciation. So that's going to be the functional obsolescence. You know, it doesn't function as well as it used to because now we've got these spaces that are too small. How does that change the value? Locational obsolescence, well, if you it used to be in a fairly good neighborhood, but now most of the neighborhoods are crack kitchens, okay? And then economic obsolescence. This is, again, the idea that there's been depreciation because of the change in the economics of this particular property, right? So, and these fall into curable and incurable. So a curable problem is one like, well, they don't have any insulation in the attic. Okay, well, once you buy the property, you got to put insulation in that, but that's something that's curable. An incurable is, well, it only has one bathroom and it needs two, so there's no place for one. So anyway, so there's curable and incurable problems, and you've got to treat those a little bit differently. Sales comparison, okay, so the buyer's max price is going to be the price of similar properties. The trouble with that is the properties are so heterogeneous that this is not going to be, again, it's not a share of IBM versus a share of IBM. So we can look at sales comparison. The buyer will buy whichever one is cheapest, given that they are truly similar assets. Okay, but determining, well, I've decided this one, and I want to get an estimate of its value. Determining exactly the value of that property is going to be problematic. Again, every property is different, right? So there's no two real properties that are exactly alike. So the solution, at least partially, is to adjust for differences, right? So we have our house, the subject house, and then we have how many others that we want to look at. Well, 3 or 4 if we're talking about a residential appraisal, and some are older, some are newer, some are bigger, some are smaller, some have a pool, some don't, some are in good condition, some aren't, some have been updated, some haven't. So all those things we're going to have to go in and make adjustments. We find the 3 houses that have sold, our comparables, we make adjustments to their value, and then we take the price per square foot and bring that back to our house. So we'd have to adjust for location. So I'm going to buy a house. One of the comparables is close to the railroad tracks. Well, that's going to mean noise, and the houses there sell for $10,000 less. So I'd take the sales price and I'd reduce it by $10,000. Size, I'm going to have to figure out what people are willing to pay for an additional 300 square feet. What about the features of the house? That'd be something like the pool, the age of the house. Typically, older homes have lower values because everything wears out. The condition, some of them have been well maintained, others haven't. And then, of course, if we have to go way back in order to get market comparables, you know, more than a month or two, or if there's been a dramatic change. But if properties have been increasing in value, so in Utah, I happen to be buying a property at the moment, and looking back at appraisals that are 6 or 7 months old, well, I sure wish they would do that because, or at least the seller would do that, because the prices have been climbing rather attractively for the last 6 or 7 months. So if you're an appraiser, then you're going to have to adjust for time if it's more than, you know, so many days old, or if you think there's been some reason to worry about that. Okay, what about due diligence? Well, if you're going to buy a single-family home for your family to live in, there's due diligence here. We're really thinking in terms of commercial properties. So you need to think lease review and rental history. So you got to go back and, you know, review all the leases. What is the vacancy rate been? What kind of tenants has there been? We want to make sure that, to the extent we can, that we can confirm operating leases. You can get utility reports, all that type of stuff. Review the cash flow statements. So we'll see what's gone. You know, what is the cash flow from the property actually been? Environmental reports. Of course, if you're buying real estate, even on a very small scale, you're going to be asked questions, or you'll be asking questions. If you're selling real estate, even if it's just a single-family home, you're going to be asked about environmental issues as part of the transaction. You may want to have an inspection. So, you know, what about the roof? You know, all those types of things. Certainly, you're going to be worried about title and legal documents. So there's depending on which country you're in, this can be fairly straightforward, or it can be a nightmare. But in the developed world, most of this is fairly straightforward, and you can buy insurance against any errors or omissions there. You may want to have a survey so that you know exactly the borders of the property and if there's any discrepancy or disputes there. And then check for compliance with local laws, codes, regulations. So there's plenty of places where they'll change code, and if you own the property, well, you're grandfathered in. But when the ownership changes, it has to be brought up to code. So that can be an issue for a real estate buyer. And then verify, the standard payments, what has the insurance actually been, what are the property taxes, have they been paid, those types of things are going to be part of the due diligence process. Okay, so thinking in terms of the private real estate indices or indexes, okay, how do we determine what's going on in the real estate market? So if you want to know what's going on in the equity markets generally, well, you can say, well, what's happened with the S&P this year, right? So I can go and say, well, from here, go back to the beginning of the year, oh, the S&P is up 14% or it's down 3% or whatever it happens to be. Well, that's easy because each of those securities transacts multiple times, if you count each individual share, millions of times a day, right? So we can look at the closing price over the course of the year, and we can get an idea of how the value has changed. That's much more difficult with real estate because these assets are heterogeneous and they suffer from the ultimate infrequent trader problem, right? So, houses are going to change hands on average, every 6 or 8 years. Commercial properties maybe less often than that. So how do we determine what's going on with the real estate markets? Well, the most popular is the NCREIF index, and this is where fund managers commit to submit data on their properties every quarter, and we get a value-weighted average of property returns. The problem here is it's not market observations. Okay? This is going to be a fund manager's assessment of the value of the property at the end of the period, the value of the property at the beginning of the period, okay? And then NOI, which is not quite as rubber a ruler as market values. So, but we're getting someone's opinion on this important part of the function. Okay? And then CapEx, I suppose you would know what your CapEx was for the quarter. So this is nothing but the holding period return, right? So this is going to be cash flow. These two things together are going to be the capital return, change in market value less any CapEx, and that's the beginning market value there. So we can break this out into two parts. We can break it out into a capital return. Okay? That's the change in market value less CapEx. So it went up in value by $300,000, but we had to put $50,000 into new carpets or whatever, so that's a $250,000 increase in value over a beginning value of $1 million. Whatever that is, that would be the capital return. What's left, okay, is this NOI over the beginning market value, and we've talked about that previously, right? So that's the cap rate. So we can get a cap rate from this, we can get a capital return, we can get a holding period return. All of that looks great, okay, except for what? Okay, well, these are not market observations, and if they are valuations provided by people, then people have biases, and that's going to be reflected in this. So this is the most popular real estate index, the one that's most cited anyway. Okay, but it's what we have and what we use. Okay, but you have to remember that it does have issues. It's not market observations. There are going to be these appraisal lags, all that sort of stuff. So it's certainly not without problems. The alternative would be to move to one of these two transaction-based indices. The first here is a repeat sales index, and that says, look, we're over some period of time. Okay, we want to find those properties that have sold twice. So we look back over the last 3 years. This property sold, 28 months ago, and it sold 3 months ago. So now we have a value going in and a value coming out, and we know the period between it, and we do that for all the properties we can get, and so within a particular class, and we say, okay, well, what would be the percentage change of value on that property over those months and the others, and you got a big matrix here, and you can come up with the average change in prices for those properties that have changed hands at least twice during your observation period, and then you can do some regression on that to get value change per quarter. What's the trouble with this? Well, remember, properties that sold twice over some relatively short period of time, those can be very different than properties that didn't sell at all, right? So those are properties that are distressed, and they're distressed because there's environmental issues or, whatever, and it's not eligible for financing because of there's a fault on it or something like that. Anyway, so this is going to be based on sales or transaction data, but then there's a big selection bias in what gets reported there. We can also do what's called a hedonic index, and a hedonic index just says, look, we're going to take the price of real assets that's in this particular category. Maybe it's single-family homes, apartment complexes, whatever it is, and we're going to regress that against these what were called hedonic factors. Okay, so we're going to do it like, location, that's miles from the central business district, the size, the use, the age, number of units, parking, covered parking, swimming pool, all, and we're going to have all of these coefficients. We're just estimating a regression equation, just like in study session 3. Okay, so the price is going to be a function of what these variables are, and we're going to get alpha, our intercept, plus beta 1 times size. All right? And, beta 2 times pool. Okay. So then if those are the only two factors, then if we want to know the value of our particular unit, the subject property, well, we've got the intercept, we know how many square feet it is, and we know whether the pool is there or not, right? And then we plug it in, and that gives us an estimated price. It's called a hedonic index. So anyway, so that's transaction-based indices, either repeat sales, selection bias, hedonic index. Well, the trouble is that we measure all these things imperfectly, so none of this is particularly good, but it's what we got, right? So we either use the NACREF, which is based on, estimated price changes, or we can use the transaction-based to have selection bias, or the the problems that, measurement problems associated with these variables. What about financial ratios? And we're getting close to the end of this. I know it's a long reading. Remember, I didn't pick it. Anyway, so the ratios here, the debt service coverage ratio, that's going to be the first year NOI divided by debt service. So if, first year NOI is going to be 1,000 and debt service is going to be, well, I'll call it 500 to make it easy. So then my debt service coverage ratio would be equal to 2. So I'm covering my debt service twice over. Loan to value, you probably know what that is, but if I get a loan of 80 on a property that has appraised at 100, then I have an 80% loan to value. Okay, what about the equity investor's return? Well, the equity investor is going to get a pre-tax return, and now this is a leveraged equity investor. NOI, well, I guess it's any equity investor. If they're not leveraged, there won't be any debt service. So an NOI minus debt service. So if I calculate my NOI to be 1,000 and my debt service is going to be 500, right, then I'm going to get 500 as my equity investor's return. It's supposed to be 100 there. So what about my equity dividend rate? Well, that's going to be equal to 500 divided by how much cash I put in when I originally bought this property, right? So some ratios to analyze it. So, debt service coverage ratio, that's going to be, just like an interest coverage ratio for an operating firm. Loan to value, straightforward. The equity investor's return in terms of dollars is NOI minus debt service, and then the equity dividend rate, it's just that the equity investor's return in dollars divided by the equity that was put into the project to begin with. This is also sometimes called a cash on cash return. All right. Okay. So what about the return if we're looking at this over a longer period of time for an equity investor? Okay. Well, we know what their equity investment was. So the property was $10,000, right? And we put in a $1,000 equity investment. So we put 10% down. So this is going to be minus 1,000 here. Then we're going to calculate our cash flow each year. Okay, and then we're going to have to come up with the cash at the time that we sell it. So we're going to have to come up with a terminal value. So that's going to be, how much we can sell it for, less how much we still owe on it, all those types of things. But then we're just going to discount it back, or we're going to find an internal rate of return or a net present value. So the leveraged internal rate of return, just the return over the entire holding period. Okay, again, you've got to come up with a terminal value because you've got to know how much you're going to take home when you close on this on the sale of the property at the end of your holding period. So we've done this 100 times. It's just internal rate of return. How much money do we put in? How much cash are we taking out each year? Okay, free cash flows, we've done that 100 times. Here we can do it essentially the same way. And then a disposal cash flow at the end of the holding period. Okay, and that brings us to the end of this very long reading. So we're going to look at, we've looked at the types of real estate here. So lots of different types. We did commercial and we did retail, or we did residential, we did retail, and we did office, all that sort of stuff. Okay, the reasons to invest, you get lots of leverage, diversification, those types of things. The risk factors, I think, are going to be fairly important. I would take this and I would say the risk factors, but I would add the drivers. Right? So when we talk about office property, well, it's going to be the job creation, right? So I would think risk factors and the drivers there, breaking it down by the different commercial types, and then the valuation approaches, which is what we spent most of the last half of the reading talking about. I would make sure that I was on top of that to be able to apply this on the exam.